join us at a moment when there is anxiety in the public markets about AI, the AI bubble, and whether or not we're getting closer to that moment and that bubble, if it is a bubble, bursting. As you sit with your view on investment around infrastructure in AI, that long-term view, how concerned are you, how anxious are you about this bubble, if that's what it is, and the risks around it?
Look, firstly, Tom, thank you so much for having us. Look, last week was quite eventful. S&P was down 2.5%, NASDAQ was down 4%, and more importantly, the Philadelphia Semiconductor Index was down 10%, its worst performance since 2020. Now, having said all of that, I would say part of this was expected. There are pockets within the market that are getting a bit exuberant, right? And over the course of this year, the Semiconductor Index was up 80%. So a 10% pullback is not bad. I think what's more important is the underlying demand for AI and AI infrastructure remains very strong, and we have a lot of bottlenecks, whether it's the wafer, the semiconductor manufacturing, or power. These are genuine bottlenecks. And the last thing I'd say, Tom, is whilst the technology firms are building the brain, Brookfield Asset Management is building the body. And the body is land, power, real estate, data centers, and compute, and we're seeing unprecedented demand across the board in all of those categories.
How convinced are you, as you make those investment commitments, that the end user is going to see that return on investment, and on what time frame?
Yeah, look, it's a great question. I would say two things. The first is we have strong conviction because we are building the backbone of AI for some of the best technology firms in the world, for some of the best sovereign governments in the world that have the best credit ratings in the world. So we're not spending capital speculatively, and in fact, are investing capital with these counterparties over the long term, where we get a return on and off of our capital over the contract term. So we feel very confident that our investments and our capital remains insulated to any AI bubbles. The second point, which is the technology firms themselves that are spending all this capex, that are signing up to these long-term commitments with Brookfield. These companies have stepped up their capex spend, whether it's Microsoft, Amazon, Google, Meta, you name it, from $400 billion just 5 years ago to $800 billion. And I would say
that continues next year.
Yeah, probably we'll hit $1 trillion at some point in the next couple of years. We have to remember, Tom, these are some of the best companies run by some of the smartest people in the world. And if you heard their earnings from last week, almost all of them are starting to report positive ROIs, which is very encouraging.
Are semiconductors or chips still cyclical, do you think?
Yeah, look, chips or semiconductors in general have always been cyclical. There's been GDP linkage, and GDP's, there's ebbs and flows. I would say what's different now compared to what happened in 1993 or the late 90s or a few times during the 2000s, what's different is the underlying demand. AI is expected or will be the most transformational general purpose technology that will require $10 trillion of capex in the next 10 years, and semiconductors, wafer, et cetera, are a fundamental piece of it, and we will probably see quite strong demand in the next few years.
How attractive is Europe as an investment destination, and the UK, given the energy costs and constraints that we're seeing here?
Yeah, look, over the last 3 to 4 years, it's been fascinating to watch the US-China AI race, and it was predominantly driven by the fact that all the AI models, which have been the primary driver of capacity or infrastructure capacity, are either American or Chinese. UK or Europe, for that matter, does not have a large-scale LLM, and does not have a hyperscaler. Having said all of that, I think UK and Europe remain really interesting investment destinations for AI infrastructure, because the next wave of AI will not be training. It will be inference. And training is research and development. Inference is revenue. Inference is application. And given the local data sovereignty laws, it is very critical for Europe to have its own local compute. And I believe UK and Europe will have an enormous runway ahead of them to basically build capacity for inference and applications.
How much of a potential constraint are higher interest rates? If we think about the ECB, expectations they hike rates, the Fed, expectations of 25 basis points comes through this year. To what extent could that curtail or factor into your investment decisions?
Look, I don't expect it to have a material impact because the reality is interest rates are still relatively low compared to where they've been historically, right? And because of what's happening in the Middle East, there's an expectation of slightly higher inflation, and that will have some impact on the interest rate, short-term interest rate curves. But when we're investing capital, we're investing in assets for 15, 20, 30 years, and therefore we take a long-term view and usually look past the noise, whether it's short-term inflation or short-term interest rates.
How much are you looking to invest in Europe, in the UK, over the next 2, 3, 4 years? Can you give us some numbers in terms of your investment commitments for this region?
Look, we are one of the largest international investors in the UK. We have over 70 billion pounds in assets under management across real estate, power, infrastructure, credit. Going forward, we remain bullish on the UK, and we expect we probably will double the size of our business in the next 5 years. Double
the size of the business in the UK over the next 5 years, and political uncertainty is not a headwind to that?
Look, when we invest in a country, the focus normally is, does the country have rule of law? Is there respect for capital? UK has both ingredients. We've been here for multiple decades, and the expectation is we'll continue to look past these political cycles, because again, when we're investing over the longer term horizon, and our views on UK have not changed at all. Because
what are the most attractive investment destinations in Europe right now? France, Germany, Italy, who stands out?
Look, depends on the vertical, but I would say across the board, some of the larger economies in Europe continue to be really interesting as it relates to AI infrastructure. We're here in London at the UK Tech Week, so let's talk AI infrastructure. I think for AI infrastructure, probably France is one of the best destinations. And the reason for that is France has abundant power, it has abundant nuclear power, it has an administration that is quite focused on ensuring Europe is independent and Europe is self-sufficient, both in terms of technology as well as the AI infrastructure. And we just last week increased our commitment to French AI infrastructure from 20 billion to 30 billion for all those reasons, and I believe France has an important, really important role to play for all of Europe as it relates to AI infrastructure.